Give us an overview of what this industry is like for a start.
I mean, it's a very complex industry to start with. I mean, looking at the whole issue of costs requires a lot of understanding and a lot of looking into various different areas. For example, we have the administration area, we have the investment management area, there's the consulting area on both sides, so whether that's member benefits or whether it's to do with the actual investments themselves. But there are also a lot of more complex costs that actually arise once you start looking beyond all of that.
And those costs have become a real concern right now. In fact, there's even an attempt to regulate on that to make them more explicit.
Absolutely. I mean, National Treasury has come out with a working paper, which is essentially a proposal for measures that will be introduced in 2014. They're seeking consultation from the industry and from the unions to look at their responses to that. It must be said that the legislation does focus on pretty explicit costs, so those are things that can be measured in rands and cents. But the point that we were trying to make today in the conference was that those are sometimes some of the smaller costs.
Right.
And that there are actually bigger costs out there, bigger elephants in the room that we need to deal with.
What are these big elephants in the room before we get into the smaller ones you can measure in rand and cents?
Yeah, I think the biggest cost that these funds face are actually opportunity costs. And these are the costs essentially that are incurred by not knowing any different.
Right.
So an example there would be asset allocation. It's very important for a pension fund to get their asset allocation right, so holding enough shares, holding enough bonds. But half the time the managers are not held to task, the consultants are not held to task, and essentially the trustees and the principal officers maybe don't have the right level of education, and that was another issue that was raised, is the professionalization of the industry, to really ask those kind of questions. And I mean, the scale of those costs is maybe 10 times the kind of explicit costs that they've mentioned today.
You represent a large number of the fund managers in South Africa, and what are some of the top issues in their mind right now going into a conference like this?
I mean, the cost issue is a very topical one. I mean, it's certainly one that's been raised by National Treasury. A lot of fingers are pointed at a lot of different parties, whether they're asset managers or consultants or brokers. But the point that, again, we were trying to make today is that you really have to try and equate the value that you're getting from the particular service that you're being given with what you're getting. You can say that something is expensive, but you can't really say that until you understand the value being derived from it.
Is this springing from the fact that just ordinarily there's a lot of mistrust between the ordinary public and insurance firms, in the sense that there's that old saying, the large print giveth, the small print taketh away?
I think that's absolutely true, and I think
Yes.
it's a big cultural problem that we do have. You know, there's a lot of comments are made about South Africans don't save.
Yes.
You only have to look at the size of the stokvel industry, and especially investment stokvels, and it's in the region of 45 to 60 billion, and that is in the lower income classes, and they do save. They just don't necessarily save through the formal sector. And I think that's something we need to address rather than them, so that we can actually develop the trust that's needed, because those stokvels are only based on trust. They're not based on anything but trust.
Yes. How do you reconcile these two? What the industry wants vis-a-vis what the regulator wants, to get something that's as suitable for both parties?
I mean, the regulator is pushing for standardization.
Yes.
Okay. And at first glance, it may appear that that's something that the industry might not necessarily want, but that's not the case, because of the fact that 90% of the market is not actually accessing post-retirement products.
Right.
Standardization will hopefully make those products more understandable to the member base, make them take up the products more, in which case the service providers can participate more. Because the situation we have at the moment is that asset managers will look after members' benefits up to the point when they retire, and then they'll take the cash, and then that cash won't last them long enough. So
how has that liability landscape changed over time?
I think the liability landscape's changed considerably, because funds have changed from what were called defined benefit funds,
right,
to what are now defined contribution funds. And
what does that mean?
Previously, under a defined benefit scheme, the trustees and the fund actuary would have responsibility for those members until they died. So they would have to provide them with a pension. With this whole shift to defined contribution funds, members are now responsible for their own retirement. So they have to save for it. They have to really take hold of the decisions and the products they buy in retirement. And unfortunately, most of the members are not equipped to do that. So there's been a huge change. There hasn't been enough education effort done to actually get the members to understand the products they're buying and the kind of considerations they have to make.
There is a term you use in the business, a net replacement ratio, which determines a member's ability to retire. Explain this for us.
A net replacement ratio is essentially, if you have an income pre-retirement,
yes,
and then you have an income post-retirement, what is the ratio of those two? And a fund will typically aim for a net replacement ratio of in excess of 75%. And they do that because they argue that once you get into retirement, your commuting costs will go down. Your lifestyle will be less expensive, so you can probably get away with 75% of the income.
Yes. And then another one which is turning up a lot now, especially from professionals like yourself, is seamless transition. How does that play into this exactly?
The concept of seamless transition is really to try and replicate a defined benefit environment in the defined contribution environment that we find ourselves now. So it's funds taking advantage of asset managers, leveraging them to get good fees, good rates for their individual members when they retire.
Right.
So the idea, don't let them open to the retail market completely. Use the power that the funds have, their bargaining power, to negotiate good rates, and put in place some simple choices for the members so that they can go from pre-retirement into post-retirement without facing all the risks that they would necessarily face at retirement.
On a big picture level, there's 26 million people who are uninsured in South Africa. How are you almost leveraging what it is you have to try and put a lot more of these people into the insurance bracket?
I mean, if we're looking at from a retirement perspective,
yes.
The idea is we need to make these products understandable. Standardization will take us a step in the right direction, but by speaking to funds at forums like the POA, we can get access to the principal officers and trustees who have the power to make those solutions available. That's how we can access the members. That's where the education needs to come from. That is the trustee's duty ultimately, is to make sure that the member has a comfortable retirement, and they can do that through education and through accessing service providers.
How does this landscape compare to other countries in Africa? Let's say some of the bigger ones, Kenya, Nigeria.
I mean, I think in South Africa we are quite a developed industry.
Yes.
I think the costs are still quite high, so I would say that our industry is quite progressive in that respect. I mean, I don't know the details on Nigeria and Kenya specifically, but I wouldn't have thought that they had been having the kind of debates that we're looking at now, because it is quite cutting-edge stuff that we're talking about.
Is one way of increasing penetration standardizing products, so everybody knows this is what I'm getting myself into, and therefore a lot more people can come into this bracket?
Absolutely. I mean, there are many studies have been done to show that if you give people too many choices, they actually won't make one. And I think most of the trustees and principal officers that we had on our panel today
yes.
agreed that the less choices you give people, the better. So it's always a trade-off. It's a trade-off between what is absolutely best for that individual member, because on average you may be right for the population, but you're guaranteed to be wrong for almost everyone.
Yes.
So there's a trade-off between that, the standardizing, and then offering complete member choice, which we've seen doesn't work.
In a sense, if you give me too many choices, I'm just confused by the dizzying amount of things that I have to choose from, and they all look like gibberish.
Absolutely, yeah. And it's a very complex industry. You can't
yes.
expect people to go overnight from not understanding or not needing to know anything about their pension to suddenly managing their own investments, choosing between a myriad of very complex products. What is
your projections for the future of this industry, very quickly?
I think for this to be a success, we need to have national social security. That needs to be a prerequisite. I think we then need to start seriously accessing the members and educating them on the kind of decisions they need to make. And from there, we can begin with professionalization, getting an idea of the costs, and really coming to grips with some of these issues.